SoFi Technologies Inc. has quickly become one of the most talked about fintech stocks in the market. Starting as a student loan refinancing company, SoFi has expanded into a full-suite financial services platform, offering personal loans, mortgages, banking, investment services, and even a national banking charter. This aggressive expansion has positioned SoFi as a key player in the evolving financial technology landscape. But with significant stock volatility and divided analyst opinions, is SoFi a strong long-term investment or an overhyped stock with limited upside? In recent months, SoFi's stock has experienced notable fluctuations, with strong rallies following earnings reports but also sharp pullbacks due to concerns over valuation and future growth. Currently trading around $14.79 per share, the stock is up significantly from its lows in early 2024 but still faces skepticism from some investors. In 2024 alone, SoFi's stock rose by 57%, outperforming many of its fintech peers. Much of this momentum came from better-than-expected earnings results, including the company's first profitable quarter in early 2024. However, even with strong financial performance, SoFi has seen short-term declines such as the 6.4% drop after its third-quarter earnings report, despite beating revenue expectations. The reason? Concerns about slowing technology segment revenue and broader market uncertainties. Financially, SoFi has shown impressive growth. In the third quarter of 2024, the company reported $697 million in revenue, a 30% increase year over year, and posted a net income of 5 cents per share. This was a significant milestone as profitability has been a key concern for investors since SoFi's public debut. CEO Anthony Noto highlighted record growth in both member acquisitions and deposits, reinforcing the company's momentum. Additionally, SoFi raised its adjusted net revenue guidance to $2.535 to $2.550 billion for the year, surpassing previous estimates by $85 million. This continued improvement in financials suggests that SoFi is executing well on its expansion strategy. A major factor contributing to SoFi's growth is its ability to leverage its national banking charter, which allows the company to hold customer deposits and lend money at competitive rates. This gives SoFi a cost advantage over non-bank fintech firms that rely on third-party banks for funding. The company's deposit base has been growing rapidly, reducing its reliance on higher-cost funding sources and improving overall margins. Another key move was SoFi's recent $2 billion loan platform agreement with Fortress Investment Group. This deal allows SoFi to refer pre-qualified personal lending borrowers to Fortress, shifting part of its lending exposure while still benefiting from its technology-driven underwriting process. This strategy aims to address investor concerns about SoFi's capital-intensive lending model and boost fee-based revenue. Despite these positives, some analysts remain cautious about SoFi's valuation. In November 2024, BofA Securities downgraded the stock from neutral to underperform, citing that the recent 120% rally outpaced the company's fundamentals. Analysts believe that while SoFi is executing well, its high valuation may limit future upside unless earnings continue to exceed expectations. The firm also pointed to slower growth in SoFi's technology segment as a possible warning sign, as this area was expected to drive high-margin revenue streams. However, other analysts are more bullish, arguing that SoFi's strong fourth-quarter results and improving profitability could push the stock another 60% higher. They cite SoFi's ability to cross-sell financial products to its expanding member base as a key driver of future growth. SoFi's long-term vision is to become a full-service financial platform, similar to traditional banks but with a more technology-driven and customer-centric approach. The company has aggressively expanded into different areas, including stock and crypto trading, automated investing, and even financial education tools. These additions create an ecosystem that encourages users to keep multiple financial activities within SoFi's platform. This is a strategy that has worked well for companies like PayPal and Square, and SoFi hopes to replicate this success in the banking sector. Looking at growth prospects, SoFi is focusing on diversifying its revenue streams away from just lending. The company's technology segment, which includes its Galileo and Technisys platforms, is expected to play a significant role in long-term growth. Galileo provides banking infrastructure to other fintech firms, while Technisys offers cloud-based banking software. These business lines generate recurring high-margin revenue and could help SoFi transition towards a less capital-intensive model. However, the technology segment's revenue growth has slowed in recent quarters, raising concerns about whether it can truly become a dominant profit driver. Another major growth factor for SoFi is its ability to capture high-margin deposits. By offering competitive interest rates on savings and checking accounts, SoFi has successfully attracted a significant deposit base. This allows the company to fund its loans at lower costs than competitors who rely on wholesale funding. The result is improved net interest margins, which contribute directly to profitability. While this is a strong advantage, it also exposes SoFi to interest rate risks. If the Federal Reserve continues to raise rates, lending demand could slow and deposit competition may increase, pressuring margins. Despite all the positives, SoFi does face risks that investors should consider. The biggest concern is valuation. Even with improving profitability, SoFi's stock remains highly valued compared to traditional banks and some fintech peers. If growth slows or the company fails to meet aggressive earnings expectations, the stock could face significant downward pressure. Additionally, macroeconomic factors such as rising interest rates, regulatory changes, or a broader economic slowdown could impact SoFi's lending business. The company's reliance on personal loans also raises concerns, as these loans tend to have higher default rates in economic downturns. While SoFi has maintained strong underwriting standards, a potential rise in delinquencies could impact financial performance. Market sentiment also plays a big role in SoFi's stock movements. The stock has been heavily traded by retail investors and has a history of sharp price swings. This means that short-term volatility should be expected, even if the long-term outlook remains positive. Another risk factor is competition. SoFi is going up against both traditional banks and fintech companies that are investing heavily in digital banking solutions. Large banks like JPMorgan Chase and Wells Fargo have the resources to offer competitive digital banking products, while fintech giants like PayPal and Block continue to innovate. SoFi needs to maintain its differentiation by offering superior customer experience and innovative products to stay ahead. In conclusion, SoFi Technologies is a high-growth fintech company with strong potential, but it is not without risks. The company has made significant progress in expanding its financial services platform, growing deposits, and achieving profitability. Its banking charter and technology platform provide competitive advantages that could drive long-term success. However, concerns over valuation, slowing technology segment growth, and macroeconomic risks should not be ignored. Investors should carefully weigh these factors before making a decision. SoFi remains a stock with high upside potential, but it comes with the volatility and risk that are typical of high-growth fintech companies. If you found this analysis helpful, don't forget to like, subscribe, and hit the notification bell for more in-depth stock insights. Thanks for watching and see you in the next video.